Well, AMC shares skyrocketing after the cinema operator was blocked by a Delaware judge from converting its APE preferred shares into common stock. AMC has filed a revised deal with the court, citing its urgent need to raise capital. And take a look at the shares there, up more than 30%. Allie, you could also argue, though, this coming on the back of a huge box office weekend with the phenomenon that is now Barbenheimer.
Exactly. So sort of the perfect storm here for the share price. And look, part of the reason why we're seeing the stock so high today is that it's a win for those current stockholders, because if those APE shares were converted, that's going to dilute the current share count. But I do think we're going to see a lot more volatility to come with this company, especially after they did submit that revised stock conversion proposal. CEO Adam Aron basically saying that they want this to happen as soon as possible, since AMC desperately needs the cash. They have a lot of debt on their balance sheet that they need to pay down. And we've been talking a lot about the double strike in Hollywood and the risk that that poses for theaters moving forward, especially with the lack of new content in the pipeline, really beginning in 2024, which is right around the corner if you think about it. So AMC, I think, is one of those names that we talk about often on this show. We've seen a bit of a bumpy ride since the meme fiasco in 2021. And you'll have to also remember that fundamentally on the street, analysts are on it, right? It has an underperform rating from Wedbush, $2 price target.
That was before the double strike.
And that was before the double strike. So there's just a lot of headwinds at this company, despite the fact that we did see a blockbuster weekend.
Yeah, it feels like a bit of good news with a lot of bad news, at least when you look ahead to what's waiting for AMC. Yes, they had a huge weekend, which, points to the fact that there is still a demand for theaters. People want that experience, but we're talking just one weekend, two huge movies that were marketed in a significant way. But the overhang is that actor strike. You pointed to that Moody's report earlier today, which is really, at the end of the day, the theaters are the ones at risk. And this happening at a time when AMC was already struggling. So yes, we saw a big pop in the stock today, but you have to wonder what is waiting, because that cloud feels like increasingly will stay over AMC for some time.
Yeah, and
not just AMC, but theaters in general.
Theaters in general, because even though this weekend was really positive at the box office, we have seen so far this year a lot of films underperform those market expectations, and a lot of big franchise films like Mission Impossible 7, Fast X, even Indiana Jones, they underperform the market. A lot of the expectation was that it was going to be high heading into the summer. So that's something to watch in addition to the strike. So we'll be following that very closely. Moving on to shares of Spotify, sliding in the red today after the audio streaming service increased the price of its premium service by $1. This comes ahead of the company's second quarter earnings before the bell on Tuesday. Now, it's interesting to see the stock reaction here, because this had largely been expected. We got the report from the Wall Street Journal on Friday that the price hike announcement was coming. But I do think a lot of investors are worried when it comes to what this means for Spotify's subscriber numbers, because they've been incredibly strong. We've seen price hikes from competitors, most recently YouTube Music. So I do think this is something Spotify had to do, especially since it's looking to increase profitability. But the impact of that on the consumer, I think investors are going to want more clarity on that on the earnings call.
Yeah, this seems like a direct response to what we have heard increasingly from investors, which is profits over growth. It's not just about the subscriber numbers at all costs. It's about show me where those profits are coming from. And when you think about its most earnings report, they did post a loss, right? An operating loss of more than $170 million. The company saying that, look, the market landscape has continued to evolve since the launch in 2008, which is really code for things are starting to slow down. We need to increase the cost here to get to that profit.
And look, Spotify, they spent $1 billion on podcasts over the past 4 years. That hit gross margins, it hit operating income. And now, considering the shift in the perspective from the investor, are you making money as a company? They've started to pare back on that. They've realigned their podcast division. They've committed to heavy layoffs across the company. So they're doing things to improve that profitability, which is why analysts have been pretty bullish on the stock. Year to date, even on the year, it's up significantly. And if you think about where we were, even at the end of last year, they've done a lot to really shore up some of that investor confidence. But it's a critical earnings report tomorrow, especially as we head to the back half of 2023.
Yeah, I know you're going to be all over those numbers there. Let's talk about another company you like to talk about,
I
Allie.
love this.
Domino's pizza chain reporting mixed results in its latest quarter. The pizza chain missed revenue estimates, but struck an upbeat tone about its recently announced Uber Eats collaboration. The company saying that entering the aggregator marketplace could add $1 billion in new sales. You could argue, Allie, they had to strike that upbeat note. Yes, many investors very excited about that, but because of the miss on revenue, sales coming in a little better than expected, but this only increases that importance of those recent announcements they had in terms of partnerships with Uber Eats as well as Postmates.
And they hinted that they're open to more partnerships like that to come, which led to that boost in share price. But despite my greatest efforts, I love the Domino's delivery app. I love that you can watch it go in the oven. You can watch it come out of the oven.
I have to try it.
I'm a fan.
I can't remember the last time I ordered Domino's.
I ordered it on Saturday, but that's besides the point. But it's interesting to see that the company reported delivery same-store sales declining for an 8th straight quarter. So it goes to your point, Akiko, about how they needed this Uber partnership to really drum up some of those delivery sales. And they did say that in Q3, delivery sales are going to continue to be weak, but that in the fourth quarter, on the heels of that Uber partnership, along with them rolling out their revamped loyalty program, that they should see some improvement there. I'm bullish on Domino's. I love their flatbread, their cheesy flatbread. I recommend that. So we'll see what happens to the stock. I mean, year to date, it is up more than 10%.
Allie alone cannot support Domino's.
Sadly, no.
Something we talk about a lot on the show. But I mean, it's not just a Domino's story, right? I mean, when you think about even other competitors that have really had their own delivery service, at the end of the day, that reach, especially with Uber Eats, is so big. You've got to have that partnership in place. You've got to be on the platform in order to break in more revenue, make it a little stickier.
Absolutely. There's just so much competition. But it was good on the revenue side that they're seeing some of those cost pressures ease, particularly around cheese. So hopefully that's a story that we continue to see.